Hello guys, welcome back to another lovely trading video. In this one we're going to be showing you how you can use the standard deviation channels as a way of investing, as we usually we only ever go over the trading aspect of using these deviations. Now, as we're looking at standard deviation channels, this is going to be more the technical side of investing. So if you're investing in less known stocks, especially do your own fundamental due diligence, whether that's going through financial statements, looking at their plans, and so on. But that will be more up to you, but we're just going to go over the technical side of things today and what you can be looking at using deviations to justify when entering stocks for an investing. So to start off, we will use the same time frames as trading, those being the 4 hour and the daily, because these will still provide us great levels to be buying in for your investment. But we can also add now some time frames, and one we can look at is a max time weekly, and then also a 3-year weekly chart. Now the max time weekly, which was the one placed before, is going to be quite difficult to use on the majority of the stocks. The reason for that is markets are at such extreme highs right now that really no stocks are near their first deviation to the downside on a max time frame. I mean, if we go through anything really on our large cap list that have IPO'd in the past, we can kind of go through. Obviously, you got to look when the stocks are IPO'd, because if they haven't been around for that long, then the deviations won't matter that much. But you want to see ones that IPO'd at least kind of 5 or so years back. For example, then plug. You're not really going to see any stocks here round down by the first deviation. So if you're looking at stock, I mean, have a quick look to see if it is there, or if it's near that first or second or third deviation on the max time frame, because if so, those will be great levels to be investing in. But yeah, just make sure it's IPO'd more than kind of 5 years back. And yeah, if it's coming into those levels on the long-term time frames, there'll be good levels, but you're just going to struggle to find some stocks that are there. But the 3-year weekly, that is one we can still use, and on stocks that you have seen pulling back quite heavily, we may see still coming into this level. Trying to think which ones may be coming into this level, like Moderna, if it comes down to 150, that's a weekly, a 3-year weekly level. But yeah, I mean, that's all you really need to do, is just kind of have a look on here and see if they're coming into it. And so DocuSign, for example, broke or gapped through the 204 level, but is coming close to its second deviation on a yearly time frame, or a 3-year time frame. So this would be considered a good buying level. And now the investing is kind of similar from the trading aspect on when we're looking to buy, and we are still looking to buy as it comes into the deviation originally, because that is usually going to be the optimal price. Obviously, sometimes stocks will continue lower, and obviously if you're investing, for example, if you're DocuSign, you're not going to be locking in profits at 230, or most likely not. So that is one thing that's different, is you don't actually have to buy the significant level. Yes, it will be a great time to buy, but for example, if you're looking at a stock and it's already kind of broken through that first, second or third deviation, you can still buy really at any point, because you are looking for the longer term, so you don't have to buy the initial bounce. But if you can buy the initial touch of the deviation, then obviously that would be the ideal time to buy. So yeah, main things, time frames, we've gone over those. 4 hour and daily, we're always going to use those. We can now use a 3-year weekly chart, and if your stock, you can use a max time frame, which will also be a weekly chart, but it's just going to be hard to find stocks that are coming into that level. So those are the time frames we're going to be looking at. Nextly is deviation direction. On investing, we tend to be looking for stocks that are heading upwards, and by that I mean deviations are pointing upwards. Reason for that is we don't really want to be investing in something that's declining unless you've done your own proper due diligence on it to say that it should be going up in the future at some point. But if you're not doing too much due diligence, which I would definitely recommend that you do, then we're only really going to be looking at stocks that are pointing upwards, because then we can at least hopefully hop on the trend of its upward movement. So that's really the first thing we're going to be looking at. For example, DocuSign, yes, it's on a large pullback. It's come below our third deviation. So this is something, looking straight off technicals, that we would say is a great time to be investing in. However, obviously you do have to look at fundamentals. There's a reason a stock would be selling off that heavy. In DocuSign's reason, it was due to bad earnings, or not even bad earnings, just worse earnings in previous quarters, or worse growth. And that's one thing to take into account when you're looking at growth stocks, is their growth is, even if they're profitable or they've had a good quarter, if it's not expected as much as analysts were predicting, you can still see the stock decline just because people are looking at it for its future growth. So if it's not growing as fast as they thought it would, that can be a reason for the sign off. But yeah, straight off technicals only, and again, that's all we're really going to be talking about in this video. DocuSign is something ideally that we'd be looking at. It's below the third, so we would consider that a very low risk entry, and it would be considered a very cheap time to be buying it. For example, if I only kept going back to statistical mean, which, I mean, if you're investing, you're probably going to be holding longer than statistical mean, but just going back to statistical mean, that is nearly 100% return on investment. But obviously, depending on how you're going to be investing, by that I mean whether you're going to be trading for or investing for a year to 2 years, or if you're trading for or investing for 5 to 10 years, your holding periods are going to be different. Obviously, if you're looking at DocuSign for a year or two investment, and then when it comes up to kind of that first or second deviation, you may look to finally close out of that position. However, if you're looking at it for a 5 to 10 year perspective, then we can't really give any price targets on it because they're just going to move so massively by that time. So yeah, that's going to be the main thing is deviation direction. For example, it's going on to Beyond Meat. It may be a stock you believe in long term, but if you haven't done your due diligence on it, then it's not something we're going to invest in because both deviations are facing down, which shows that it's in a strong downtrend. So unless you've done your due diligence to tell you from a fundamental basis that the stock should do better in the future, then it's something we would definitely look to stay away with. Sometimes you do get a bit of conflict. For example, on Citigroup, we're seeing now on the 4 hour it's facing down, the deviation is facing down, on the daily they're facing up. Now this is something you tend to see more when it's sector rotations, meaning when growth stocks tend to perform worse and value stocks tend to come in, and the reason for that is just you're picking up the trend on the 4 hour that now the banking stocks are starting to pull back, but on the daily it's still overall trending up. So when you see this, it's a bit more harsh to pick, or hard to pick a decision, and it's more of a personal preference. You can avoid stocks where one deviation is facing down, one's facing up, or you can decide to still invest in. And this again, it's not going to make the biggest difference depending on your time frame. If you're looking maybe for a year, then it could be better maybe to avoid these. However, if you're looking more for a 5 to 10 year plan, it's not really going to make much difference. Now the next thing is buying on the level. We did kind of briefly mention this before, and one thing we'll go over again is if you can ideally buy exactly on the deviation level. The reason for this is when stocks reverse, they tend to do it off these deviation levels. So if you can be buying right at the deviation level and you're looking for a long-term hold, so the stock can go against you and it doesn't matter as much, if you're buying at this level, you're more likely than not going to catch the bottom eventually. So for example, at Citi, if you bought at the first deviation, obviously it's sold off some more since then. It's not the end of the world if you're long-term investing, because obviously we would expect Citi to push past that kind of $66 level. But if you were buying at the deviation level, then coming down now to the second one, this could now be our reversal zone. We're saying at 59.80 is where the second deviation is on the 4 hour. So for all we know, this could be the bottom of Citi, at least on this downward move, and that could end up being its reversal level. So we tend to buy or try to buy exactly on the deviation level because then we're kind of getting the best price possible. However, occasionally, or if you need to, you can buy once it's broken below a level. Again, we'll go back to DocuSign because it's a great chart for it. But with DocuSign, we can see it's already gone below that third deviation. So we're not buying that initial bounce, but in sometimes if they are going to break below, you are at the end of the day getting a better price. So it's not a bad thing if you can buy below. But that's usually something you won't know until after it's happened. So usually the only time we'll use this way of investing is, for example, with DocuSign it's sold off, and let's say we didn't really look at the chart of DocuSign until the day after, or Citi for example. Let's say we didn't see the chart until Friday, then we would have seen, okay, it's broken past the 61.70, so we could definitely invest some here because it's already below that level. So it is considered, I guess, a good time to be buying. Now, one thing else we wanted to go through, and most likely be the last thing, we don't really need to go through stocks because, again, if you're investing, you're buying quality companies that you like. So most people don't really tend to have stops on investments. They'll just reevaluate their investment maybe every year or two or every quarter, and see, is there any fundamental changes that they don't like anymore, and if so, that would justify either selling some stock or maybe buying more of it. But the kind of last thing we wanted to go through is maybe diversifying between different stocks, and by that I mean, obviously you should have a diversified portfolio. It's probably better than just one or two stocks, but we can buy the same kind of stock but by picking different names. For example, actually a better example would be AXP, which is American Express, and then Visa. They kind of have the same kind of purpose. They will most likely move the same way, as we can kind of see how they've moved. For example, look at Visa for the last year, how it's traded. If we go over to American Express, it's traded somewhat similar. They tend to do their growth spurts the same, and they tend to do their pullbacks the same. But the reason we wouldn't mind buying, for example, let's say you were going to put 10 grand in PayPal or Visa or American Express, what could always be a good idea is maybe putting 5,000 say in American Express and 5,000 in Visa. The reason we say that is then you kind of diversify the risk and also upside of if there is any news that comes out which could long-term affect the company. For example, Visa recently had news, at least in the UK, I don't think it affects the US, but in the UK, of them getting rid of Visa credit cards to be able to buy online. Reason for that was just the excessive fees. So it's something we did have an initial reaction that was due to that large sell-off here. But we don't really know if it's going to have a long-term effect. It most likely won't. If people want to use credit cards to buy on Amazon, they will just probably get a different, they'll just get a MasterCard or an American Express to do it. So it may not have a long-term effect, but in this case, this is when it would have been a good time to be diversified between, say, American Express and Visa, because the sell-off on American Express wouldn't have been as hard on that. Obviously it did pull back, but you'll see it didn't it came back to the second deviation on the 4 hour, and not even to the second deviation on the daily. And if we go over to Visa, we can see it's come down to the third deviation on the daily and to the second deviation on the 4 hour. So when you see something like that, that's why we like to diversify between the similar stocks, because we kind of offset some of that risk. And that's one thing as well, actually, you'll notice is on Visa, the 4 hour is now down trending, whereas American Express is uptrending. Reason for that is, again, the sell-off on that Amazon news was a lot more harsh on Visa than it was American Express. So we would expect it to maybe have, maybe not the longest time effect, but again, it could affect it in, say, a year or two. So that's one reason why we like to diversify between the stocks, because then they'll still tend to move the same overall. But again, then we can also catch some good news. For example, let's say Visa comes out, they have for example, when they had a partnership with Amazon originally to supply their card, then you may see its big jump, and it may move quicker than American Express. And again, MasterCard, when the UK launched, or when Chase Bank, so JP Morgan Chase launched their UK card, they ended up using MasterCard instead of Visa. And I do think we ended up seeing some movement when this was announced. Could have been this movement here, I'm not too sure. But again, having being able to catch the good news on some stocks as well is also helpful. So that's why, again, another benefit to kind of diversifying between 2 or 3 names within the exact same sector. It's going to be harder on some stocks though. For example, Tesla. If you're looking for EVs, yes, Tesla's probably going to be the best name for it. You have the kind of the meme stocks like the Lucid, Rivian. Those are ones you probably don't want to be investing in the same, because a lot of them aren't even producing cars. It's more of just the hype of EV. So if you are looking to do it on something like a Tesla, you want to be looking at companies which are looking to properly diversify into creating electric cars, or already are. So I think GM was one where they are looking to do quite a lot of electrics, or electric cars or EV cars coming into the future. Could be wrong on that. I don't keep up too much with EV news because it's not something I personally trade or invest in too much. But yeah, that's kind of the overall point though, is just kind of diversify between names. You don't have to, but it can be helpful to do, especially as well if you're buying deviations. You may find let's say on American Express it's at a deviation level, where on Visa maybe it hasn't yet hit a level, so it allows you to kind of get in one of them. You can wait for the other one to pull back. If it doesn't quite pull back to a level that you want to invest in, then at least you still got some size in, for example, that case, a financial service. So that is kind of a small kind of summary on how you can use these deviations to invest. Again, that's not everything. Obviously, you want to be looking at the fundamentals, long-term assets, and obviously you have a portfolio that you like. You don't just be buying whatever stocks come into their deviation levels. You want to be thinking what you actually want to hold long-term. For example, you might want to have some banking stocks. So you can also justify kind of what banking stock you want to have. Do you want Bank of America? Do you want JP Morgan? Do you want Goldman Sachs? You kind of have to go through that. They'll probably all come into the deviations at the same time, or roughly the same time, so you just have to justify which one you want to buy, or the few that you do want to buy out of the, for example, banking industry in that sense. So I hope you enjoyed the video. Hope to see you in the next one, and that's it. Peace.